pleased right now to be joined by Duncan Bourne, who's Managing Director of Wynnchurch Capital. Thank you so much for being with us.
Good to be here.
Tell us a little bit about your company and the types of transactions that you focus on.
Wynnchurch is a private equity firm that makes investments in middle market companies, typically manufacturing businesses, industrial companies, or services businesses that serve industrial businesses. And so from that perspective, we're sort of an old line private equity investor. We're interested in generating value at the company level. We're not so much of a financial investor. We don't really trade in distressed debt or things like that, but we buy companies that are underperforming and we try to make them better.
And you've been around since 1999 in Chicago, based in Chicago, correct?
Yeah, Chicago. We started, the individual that started our firm is a former individual from GE Capital. He knew a lot of folks throughout the Midwest and throughout Canada, and so we tend to invest still in companies that are throughout Canada. About a third of our deals are from Canada, and the balance of them are, I'd say, heartland of America, but we have portfolio companies sprinkled throughout the United States.
If we could talk a little bit about that, a little more about that, the type of companies that you're helping to turn around.
They tend to be companies that have assets. They tend to be manufacturing businesses. Back in the mid-2000s, we got involved a lot in automotive. That was pre the big downturn, so that was, if you think about it, that's kind of risky. So we got involved in working with businesses that were not particularly profitable, but they could be made better. So we brought a lot of operational help to the mix, brought in some outside board members, outside directors, outside management teams sometimes, to help the businesses perform better, to earn more money, and therefore create value for our limited partner investors.
What factors would you say are often overlooked when valuing a distressed company?
The factors that we see a lot are people these days, I think, are valuing distressed companies very high. And so it's a very, very competitive marketplace out there for even the distressed assets that are available to acquire. And we scratch our heads at a lot of situations where we think that people miss it, is that they don't effectively consider how long it takes to turn around a business. It takes 2 years oftentimes to turn a business around, sometimes longer. So you need to factor in the amount of capital that you have to put into the business to capitalize it appropriately, the amount of investment that's needed to get the business back on its feet, and how long it's going to take before you can get your management team and the company culture back to where you need it to be for it to be very profitable. So you need to fund that runway, if you will, and I think people forget about that sometimes.
And that really does seem like it would be the challenge when you have corporate executives who've been with a particular company for so long and now it is in trouble righting the ship, as you say. It takes a long time. But I would think that some of them might be a little hesitant to relinquish a little bit of the power, but you have to step back and have somebody from the outside who knows what they're doing turn it around. Yeah,
but that's also challenging too. It's interesting you raise that, because oftentimes we get into situations where management has tried their best to get outside financing. They've gone back to the debt market several times over. And that's the fix where they think, oh gee, if I just had a little bit more cash, I'd be able to fix this problem, get through this tough quarter, get through this tough year. And then they find themselves still in the soup after get a little more debt, get a little bit more of their assets are now somebody else's collateral, and they find themselves in even deeper trouble. So then finally they reach out to us, but in some cases that's a little late, because then their companies haven't performed that well for a little bit longer period of time, and it is now a tougher deal. And so you see that a lot with management teams. What we try to communicate with management teams is, listen, we can be a helper to you. We can come in, sometimes we can be a minority investor in a situation, and we can bring in, again, the outside talent that can help you, particularly for private company owners, where they don't want to give up control. We can help you with, hey, let's get your business back on its feet. We can generate a lot of significant wealth for you, generate wealth for us as well, and for our limited partners. Mm-hmm. But the key is that you're not going to end up with a big goose egg because you haven't taken the right steps at the right time.
You have to be realistic. As a management company, there are other management companies out there. You guys have been around since 1999, so you have a track record. What would you say sets your company apart from the others?
Well, first of all, we're in our third fund right now. We're about 2/3 of the way through that. We're going to be going out to market for our fourth fund in a little while, about a year from now. Currently, we manage about $1 billion. We're investing out of a $600 million fund currently. I think what differentiates us is that our success, fund after fund after fund, we've been a top quartile performer each of those three funds. and which really sets us apart. It sets us into a very select class of private equity investors in general, and then in particular distressed investors, particularly the style of investing that we're doing, which is generating value by the companies performing better as opposed to debt trading or doing other sorts of sort of speculative type investing.
The U.S. economy is improving, but then, of course, many other factors come into play when you're talking about companies becoming distressed. What do you see as far as the outlook, do you think, for the rest of 2004 and into 2015, as far as opportunities for helping, assisting distressed companies?
Yeah, it's a very soft market for distressed right now. So what we tend to think about are there are some cyclical businesses, industries that we want to get involved in, and so home building is coming out of the doldrums, I think, finally, but it's going to be a long time. I think that there are certain industries that are in cycle. Some are very frothy right now. So, for example, oil and gas, there's not a lot of distress there, so that's not a good place to be a distressed investor. But with froth, there come opportunities every so often that pop out. People get a little bit over their skis on something, and then there's a situational opportunity that arises. So you always have to be on the lookout for those sorts of things. Also, businesses where the cost of labor is increasing because the economy is not really going leaps and bounds in growth. A lot of companies are having trouble with their top line, but their employees continue to get raises every year, and for a company that has a lot of labor cost in its P&L, those companies are increasingly getting more and more challenged. So we see potential opportunities there as well, and that's where you come in as an operational restructuring person or a performance improvement person. That's where opportunities to sort of reset how the company does business gives you a potential profit-making opportunity.
Well, Duncan, you've shared some great insight with us today. Thank you so much for being here. Appreciate it.
Nice to be here.
Nice to be here.
Thanks.